Are you looking for a way to save more in taxes while maximizing your charitable impact? There's a year end strategy that could help you do both. It's called bunching. Instead of spreading your charitable donations across multiple years, you combine 2 or 3 years worth of giving into one year. This lets you exceed the standard deduction threshold and actual itemize your taxes, turning donations that weren't helping you tax wise into real deductions. But here's where it gets even better. Use a donor advised fund or a DAF. You contribute multiple years of donation to one lump sum, get the full tax deduction this year, then distribute the funds to your favorite charities over time. You control when and where the money goes, but you get the tax benefit immediately. In this video, I'm going to show you the actual impact the strategy has on a tax return. All right, so here is a 2024 tax return. Okay, so the 2025 tax returns haven't been out yet. There are drafts of what the versions are going to look like. There are going to be changes given the new tax bill. But I just wanted to walk you through, just pretend this is a 2025 return and the changes that you can do from a charitable donation and how that will impact your tax return. So 2024 tax return, we're going to skip down to, and if you want to pull up your personal return from last year, you want to look at the adjusted gross income. So in this case, Ferris and Sloan, their adjusted gross income is 422, and there's the standard deduction or itemized. And for this year, the standard deduction for a married filed joint is, I believe it's 31,500. So you take the higher to the standard deduction or itemize. And in this case, the itemize is higher. Now, the standard deduction was slightly lower in 2024, but in 2025, the standard deduction is 31,500. So we're going to jump to Schedule A here. So in Schedule A, we see that there's no medical expenses. There's taxes paid. This is like real estate taxes, taxes paid on their W-2 to the state. And this was capped at $10,000. Now the change here, and I'll cover this in another video, in 2025, that the bottom is $10,000 and the cap is $40,000. So they might be able to take advantage of this new rule here, but we're not going to cover that here. So to say the max is $10,000 for them, that's one component of the itemized deduction. Then we get into interest paid for charitable interest paid on your mortgage. So you want to see what that is. And the sum of those two right there is $35,000. That alone is more than the standard deduction of $31,500. Now we get down to gifts to charity. Now, for those that are charitable inclined, meaning that you tend to give to charities every year, this is a nice way where if you're looking for ways to kind of increase your deductions, you can certainly do it in this way. So to say you plan to donate $5,000 a year in charity, instead of doing $5,000 this year, $5,000 in 2026, $5,000 in 2027, why don't you group all that into 2025 here? So instead of 4,700, we're going to change this to 15,000, and I'll change that so you can kind of see the impact here. What that does, it's going to increase your itemized deduction here, and then it's going to reduce your total taxable income. So right now, their total taxable income is $375,000. The tax on that is $75,000. Their total tax liability at the end of the year that they owe is about $10,700. Now we're going to change this, and we're going to say that instead of contributing $4,700, what we're going to do is it's called bunching, right? So we're going to group a couple of years of donations into one year. We're going to see what this, how that impacts their return here. Now, there's also the idea of, so there's the concept of bunching, right? But there's also the idea of setting up a donor advised fund. What a donor advised fund is you put in, I'm just making this up, $50,000 this year, okay? And you really want to bunch all your donations in one year. And you get to deduct that $50,000 this year. But you don't have to identify the charity and where to donate those funds. So you can wait to do this over a couple of years, which is nice. So you had a great year in 2025. You're looking for ways to kind of reduce your tax liability, and this was one of the ways. So you can set up a donor advised fund and you put in $50,000. I just made up that number. You can put in $10,000 if you want to. Then it's kind of like an investment fund, right? Where the money is going to grow. And then when it's time where you identify the charities, then you can take that money out of the fund and donate to that certain charity. If going back to the $50,000 example, if you decide to deduct all $50,000 in the year that you put in the donor advised fund, 2 years from now, when you decide, okay, I want $10,000 this charity, you can't deduct the $10,000 again. Okay, it's because you've already taken that. So let's go back to this example of Ferris and Sloan. So this itemized number now increased by $15,000. So their total taxable income was reduced, and then their over tax liability reduced by $2,000 or more than $2,000. Because remember, this was about $10,000. So now their tax liability decreased. So if you're looking for a way to reduce your tax liability, you can take this concept of bunching and kind of maybe contribute more this year to charitable donations. If you know maybe next year it's not going to be as a big year in terms of earnings for you, and kind of put that all here. So that's what this video is about. It's about bunching. It's about taking a couple of years worth of charitable donations that you would do and put them all in 1 year. Also, introducing the concept of a donor advised fund, which you can, again, put a bunch into a given year into that donor advised fund, but you don't have to identify the charity to donate all that money to, but you get the tax benefit in the year that you put the money into that donor advised fund. So it's kind of like a win-win. If you have any questions, leave them in the comments below. Thanks again for watching.